Welcome to another episode of Lunch with the Shark. Join us as we dive deep into discussions about business, accounting, and finance to help you build a business that thrives. Now sit back and have a bite with your host, the Shark CFO, Vidal Espinosa.
Well, hello, and good afternoon. Welcome to a new edition of Lunch with the Shark. I am your host, Vidal, the Shark CFO Espinosa, and we are actually heading back to San Diego, California at this moment. We are broadcasting live from the International Airport in Guadalajara, Jalisco, and we're heading back to San Diego this afternoon in a couple of, not actually a couple hours, like in 90 minutes, we have to board our plane. It was a great trip. It was very relaxing. It was great seeing the people down here, mostly my family, our family, and we still have something pending there with Ana Sofia and Emiliano, which is their business proposal, which they're gonna pitch to their Shark, Uncle Shark. It's so funny because before we left, they're like, when are we going to do our pitch? When are we going to be again in the show? So they're excited. They know what they have to do. And we're also really excited as to what they're going to present to us. And it is the season. It is the season. I know, first of all, it's the holidays, but a couple of weeks ago, we actually started the tax planning season. And we actually going to go over this topic for the whole week. We're going to be talking about tax planning and what it is, how to do some tax planning. But first, today, we are going to start with not tax planning, well, a couple of topics about tax planning, but we're going to go over what's the difference between tax planning, tax avoidance, and tax evasion. A lot of us heard about the tax situation with Donald Trump. So the thing here is, and I think we spoke about that, is that tax evasion, people were saying, oh, Donald Trump is tax evading. But believe it or not, it wasn't tax evading, it was tax avoidance. And because he does some tax planning. So by definition, tax planning can be understood as the activity that undertakes by the assessee, which is the taxpayer, to reduce the tax liability by making optimization use of all permissible allowances, deductions, concessions, exceptions, rebates, exclusion, and so forth. That is actually tax planning. And whenever we do tax planning, we actually reduce our tax liability. Okay? So the difference between avoidance and evasion is that when you do tax planning, you do tax avoidance to your tax liability before you generate the tax liability, or before you know which is your tax liability, compared to tax evasion, which is the complete avoidance illegally of your tax liability. And it's actually done after the fact, after you know your tax liability, okay? And we can't do that, okay? We can't, it's illegal. Technically, it's illegal, right? So tax planning ensures that you are tax efficient, okay? It is legal, and you use any available law to reduce your tax liability. And it's done before the tax liability occurs. Tax avoidance minimizes your tax. It is legal, and you usually utilize loopholes in the law. But you comply with law provisions. Okay, you comply with law provisions. And we're going to take the example of Donald Trump's tax return that were presented by the New York Times, because a lot of us know about that. And we all said, oh my God, how come he says that he's a multimillionaire and he owes a lot of money on his own? Well, that's actually a tax strategy to avoid taxes, because it generates interest, liability, which is a tax deduction. He has a lot of assets, but he owes them, right? So he takes those assets and depreciates them in accelerated method. Not all of us know how to utilize those strategies. He does. He actually has a team of tax advisors that help him and other businessmen like him to minimize your tax liability. When it comes time for you to pay taxes as an individual, that it's a business owner, obviously you want to pay the least amount of taxes. Okay? Listen, the least amount of taxes possible. When you go to your tax accountant or tax advisor, it's probably too late. You probably go and visit him a couple of weeks ago, the first couple of weeks in January. You don't even have books, which is accounting, bookkeeping, and you don't know what's your profit. You don't know what's your loss. You don't know if you needed it to buy assets at the end of the year, even though you don't pay for them. Even if you generate a debt, which is financing them, you can actually depreciate it by an accelerated method that's allowed by the tax code, and that will help you reduce your tax liability. Now, what you need to understand is that there's different ways to reduce your tax liability. The first ones are deductions. Okay, deductions. That's what actually goes and reduces, first of all, your taxable base. Your taxable base is income minus expenses, gives you your taxable base. Okay, based on your taxable base, we calculate your tax amount, your tax liability. Okay, so any deduction, okay, it's allowable, right? But we won't know how many deductions you needed, if you are okay, if you're not okay, for tax purposes, unless you have books, unless you have accounting, and it's clearly recorded, it's accurate. Okay, it's not just doing QuickBooks Online. It's not just dumping your bank account into a spreadsheet and classifying it as you think, right? I've seen accountings or books that they utilize as a vendor the check number. That's not right. That is not right. The vendor is the person or company that you're paying that expense to. It's not the check, it's not the bank, it's the person or company that you're paying that expense to, right? So you need to classify it under that name. Now, I've also seen that we generally, my neighbor, my friend, everybody tells me, oh, open a company because you can deduct everything that you can do, and you can deduct everything from your life. You can deduct. That's actually tax evasion, believe it or not, because you're not using the law, you're not using your company in the right way. Remember, anything that is deductible must be necessary and ordinary for your business, okay, when you're doing a business. Now, tax avoidance, the purpose of it is minimizing taxes. It's actually legal. And the nature is to avoid loopholes. Yes, 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 yes. Holy crap, why are there loopholes? There are loopholes. People that study the tax code find ways to minimize and utilize the tax code in our advantage. People, if you are not using the tax code in your advantage, you're actually overpaying taxes. Yes, you are overpaying taxes, because if you were to use the tax code as it was supposed or as it is written, you would be minimizing your tax liability. Now, we already explained what's a tax deduction, okay? Now you have tax credits. Tax credits are credits that can be refunded, okay? Or goes and reduces your tax liability, which is whatever taxes you owe, it reduces the amount that you have to pay in taxes, okay? So those are tax credits. And you can utilize as many as tax credits that fit your persona as an individual or as a business owner. And either you can reduce your liability to zero, you might get a refund. A lot of people get a refund in their personal tax returns, not because they overpay taxes, but because of refundable tax credits like earned income credit, like child care, like child credit. Those are refundable. That's why you get a tax refund, okay? So, and then we have tax evasion. Tax evasion, the purpose, it's not paying taxes. In Mexico, taxes are the mouse and the cat play game, okay? Mouse being the taxpayer and the cat being the government. They're trying to collect as much taxes, and it's a game. It's the national sports game, trust me. And it's illegal. It's illegal in nature. It employs illegal means, obviously, and it's done after the tax liability. Shit, I have to pay $100,000 in taxes. What can I do? Well, there's not a lot of things that you could do. You could have tax planned to reduce your tax and create a tax avoidance strategy and maximize, but you didn't do anything during the year. You see your tax accountant or tax advisor on April 15th. Please file an extension. I've seen a couple of weeks ago, I actually saw a tax return where the accountant filed a partnership tax return in zeros to not generate a tax penalty for not presenting the tax return on time. And then he filed an amendment saying, oh, we forgot to input data. Really? So you file a tax return in zeros, and then you present an amendment with the accurate numbers and say, oh, we forgot. That's actually tax evasion. That's not tax avoidance. That's filing a tax return that it's incorrect, knowingly. Every tax return is signed under penalty of perjury. Okay? So the exercise here is done after the tax liability. The impact, there's a penalty or imprisonment. You can actually go to prison, and there's very hefty penalties. Okay? So knowing that and understanding what is that I need to do is the tax planning must be done through the course of the year. You must be tweaking, fixing, minimizing, increasing. You must have a guidance, okay? And tax planning, it's for long term, okay? Now we are recreating tax planning because we have a new president in the United States that is going to be sworn in January 21st. And we are more certain, we're sure that he's going to eliminate whatever the tax, what is it? I forgot the word. Whatever the tax reform that Donald Trump presented 4 years ago or 2 years ago. And we're going to have to go and readjust every tax planning that we've done for our clients, past clients, future clients, right? So we are studying right now what he is proposing for businesses and for individuals. He's going to eliminate certain credits, he's going to increase tax rates, and we have to plan accordingly. But we don't plan the day off. It takes time, okay? So tax planning, it's for a long term. So here's a tax planning for beginners. And you know what? I am not asking you to do your own tax planning because you don't know what you don't know, right? I can give you the recipe name, okay? I can give you, we're going to prepare cinnamon rolls, but I'm not going to give you the recipe. because every single household has a different recipe for cinnamon rolls, right? Some people use pecans, other people don't use pecans. Some people use brown sugar, other people can use or eat brown sugar and they'll use stevia. Other people like certain type of wheat, and other people like other type of flours. So every single recipe, it's different. Even though at the outcome of finalizing that recipe, you get a very nice, soft, spongy, really, really good cinnamon roll. It's not the same recipe. Okay, so if I tell you, hey, let's do the Augusta strategy, you're gonna Google it and you're gonna be like, holy shit, I'm gonna apply it. Well, it does not apply to individuals. It only applies for businesses. It only applies for certain businesses. So don't do it. Now, oh, I'm gonna take accelerated depreciation 179 section. It doesn't work maybe for you. It maybe works for somebody else, but not for you. Oh, they're telling me to go and get a car and make it a lease, and lease payments are deductible. Do you have a business? Oh, yes. I'm going to sell Mary Kay. Okay. Are you really selling Mary Kay? Yes. Here, I paid my due for Mary Kay and I have a business. How many clients do you have? My daughter. And for how many months did you do that? For a couple of days. You don't have a business. That's a hobby. So you need to be very careful when it comes to tax strategies. Okay? So to understand here, we're going to go over 5 tax strategies. So we're getting close to the end of the year. So now is the perfect time to do some tax planning. Okay? So we're going to talk about 5 tax strategies and concepts to know as a business owner. Okay? As a business owner. The first one is understand that there are several personal tax brackets. Okay, so if you're an individual that has a business, a small business, you're Schedule C, and most of us that are business, and we've done business for a while, we mostly start as a solopreneur, as an individual, as a business owner with a small business Schedule C. Okay, so you should understand that the United States has a progressive tax system. That means that there's a table that it goes from 0% up to 35%. I think, when was the last time? Here it is. Give me 1 second. Thank God for computers and the systems, because I usually don't. So it goes up to 35 or 37%. I really don't remember, because we use the table not very often. So that means that people with higher taxable income are subject to higher taxes. Okay, while people with a lower taxable income are subject to lower tax rates. How does this impact my business? Well, if you can work with your accountant to reduce your reportable income, you will be in a lower tax bracket that's paying less taxes. There are pluses and minuses to this. So speak to your accountant and understand the consequences. People, you might be a $1 million revenue company, right? But you want to deduct everything, including the dog and your kitchen sink. You want to deduct everything, okay? And you come up with a taxable income minus deductions of $50,000, okay? Perfect. That's up to you and your tax advisor. And then you want to go and buy a house. Well, your only income is $50,000. No. I have generated $1 million. Yeah, that's in revenue. That's not in taxable income. Lenders will look at your taxable income. Okay, whatever is in the first page of your 1040, not whatever it's in the page for your Schedule C. Okay, so be very careful when your tax advisor says, "Oh, you're not going to pay taxes," and your plan is to buy a house in the next couple of years. Well, in that instance, in that case, you're screwed. Yes, you save in taxes, but you're not going to be able to afford a house for of your liking with $50,000 of taxable income. It's a little bit close to impossible to get a mortgage. Okay, talk to your mortgage lender and he's going to let you know. Number two, understand the differences between tax credits and tax deductions. We already explained it. So a tax deduction and tax credit may be the best part of preparing your tax return. Both reduces your tax liability, but in very different ways. Very different ways. Knowing the difference can create some very effective tax strategies that reduces your tax bill. A tax deductions are specific expenses you incur that you can subtract from your taxable income. They reduce how much of your income is subject to taxes. Okay, if you are an individual, okay, most likely you would be able to generate a tax deduction that it's directly based on whether you're single, head of household, married filing jointly, married filing separately, a different way, right? Most of us have heard, oh, I'm going to give a donation and this is tax deductible. Well, yes, only if you generate an itemized deduction. When do you generally create an itemized deduction? Whenever your deductions are higher than your standard deductions. Standard deductions are minimum deductions that the government allows you to eliminate from your wages or business proceeds. Okay, let's say that I generated the $50,000, right? Now I'm married filing jointly, maybe my deduction, or single, my deduction is, let's say, $15,000. So to those $50,000, I'm going to subtract $15,000. So I end up with $35,000. I am going to pay taxes only over 35. Okay, so that's a tax deduction. Now, tax credits are even better. Okay, they give you a dollar for dollar reduction in your tax bill. A tax credit valued at $1,000, for instance, lowers your tax bill by $1,000. Okay, lowers your tax bill by $8,000. So let's say that we are paying taxes over $35,000, and my tax bill is $3,500 with 10% taxes. I'm not using accurate numbers. Okay, this is just for example. So I get a credit of $1,000. So I am only going to pay taxes for $2,500 in this instance. That's what we mean dollar for dollar. Okay? Number three, tax strategies to shelter income or cap your tax bill. 401ks, health savings account, fund your flexible spending account for you and your employees if you have a business. Those strategies will help you reduce your tax base, so which is your taxable income, for tax purpose calculations. Okay? Now, there's another strategy or another way of doing this, which is deferring your expenses, which is strategy number 4. Defer expenses and accelerate income, or vice versa. If you have a business, okay, what you want to do is only if your tax accounting is on an accrual basis. Only if your tax accounting it's on accrual basis, not on cash basis. Okay? Because when you're on cash basis, everything that comes into your bank and goes out to your bank account must be accounted and reported on your tax return. If you're on accrual basis, you can actually defer your invoices, whatever you're charging your client, for future years, but you can request your vendors to send you invoices and accelerate those expenses, okay, that you probably gonna incur or pay them next year. What you do there is you reduce your taxable income or your revenue, and you increase your expenses that are necessary and ordinary for your business. That way, your taxable base or your tax profit, it's lower. Okay, so you can actually play with that. Be very careful when you're doing this because you must know if you're counting it on a accrual basis or cash basis. And it only works if you have your tax accounting for on accrual basis. Okay, so those are four strategies that are very easy to apply. You must know. You must know all the terms. You must be very versed when it comes to the tax code if you're implementing that. TurboTax, Tax Act, any of those H&R Block, any of those tax softwares that are do-it-yourself are not going to tell you which strategies to utilize. If you call their hotline, the accountant or the CPA that it's on the other line does not know your story, does not know your business, does not know your household, does not know what's the future for you. So it's going to be a little bit impossible for them to advise you on what to do and what not to do. They're going to advise you on how to input your current information. But there's no time machine that it's going to set back time that you can actually generate a tax strategy from past activities. You can't. It's close to impossible. Trust me, close to impossible. So plan accordingly. Plan accordingly. Tax strategy, it's not illegal. Tax avoidance, it's not illegal. You pay taxes because you have to pay taxes, but you don't have to pay a lot of taxes, right? You don't. You have to pay your fair share. So plan accordingly. Tax rules can be complicated, but taking some time to know the basics and help your accountant use them for your benefit can change how much you end up paying, okay? Most CPAs are not tax experts. I'm going to have my CPA prepare my tax return. Are there tax experts? I don't think so. Most CPAs are not tax experts, okay? So be very careful. I'll have my CPA. There's people that are like, they just like, I'm going to go and meet my CPA. What for? He signs financial statements. He signs audits. He signs compliance. He's not a tax expert. So he's not helping you maximize your tax credits, right? Or tax deductions. So be very careful with that. Spotify, it's a great place to hear previous episodes. It's really easy to subscribe. So Jesus, take the wheel and play the video. Open Spotify, and in the search bar on the top, type in Lunch with the Shark. Select the Lunch with the Shark podcast. Once you do, select the follow button right next to the green play button. By following us, you will get all the notifications for when we upload new episodes on Spotify. So, today, I don't know which quote we have prepared. I see one in my script, so which I'm going to follow. And I am actually gonna go ahead and do both, Jesus. So this quote comes from Hugo Black. He is a U.S. Senator and Associate Justice of the Supreme Court to the United States. And he said, the United States has a system of taxation by confusion. Listen to this. The United States has a system of taxation by confusion. Every single system can be hacked and break. That's what the tax code is for. And Jesus, let's do the other quote as well, because this quote comes from Morgan Stanley. And he said, "You must pay taxes, but there's no law that says you gotta leave a tip." Do you understand that? You don't have to overpay taxes. Give us a call. Let us help you with your tax strategy and help you minimize the amount of taxes that you pay. It's been great seeing you today. We'll see you tomorrow from San Diego, California, back home. And bon appetit. Ciao.
Thank you for listening to Lunch with the Shark. If you would like to set up a consultation with the Shark CFO, Vidal Espinosa, visit his website www.invictus-advisors.com, and don't forget to subscribe on Facebook, Instagram, YouTube, Twitter, and LinkedIn.